And welcome to this episode of the Capitalized Life and Retirement Show. I'm your host, Matthew Johnson, president and owner of Johnson Wealth and Income Management, a retirement income source located in Clear Lake and Humboldt, Iowa, serving clients in northern Iowa and southern Minnesota. Well, how are you today? I hope you're doing well. Hope you're taking a little bit of time for yourself. And I just want to say a warm welcome to today's program. If you're new to the program, a special welcome to you. This is a program in which I, as your host and as a advisor and fiduciary, want to be able to give you hope. I want to be able to educate you. I want to be able to give you the tools necessary so that you can have the retirement that I believe you deserve. That's an income that's going to produce more income than what you need. And today we're going to be discussing a whole host of various different things because, quite honestly, even though we can look around and we can read the news and we can talk to our friends around the water cooler and read articles and scroll through our social media, and we can see more than enough negative to last us a lifetime, the reality is that there is positive things that we also need to be keeping our eye on. And we can't just be filling our vessel every single day with negative stuff. We've got to be able to look at positive things as well. And today we're going to be discussing some of those things. Now, if you're brand new to the program and you're maybe getting closer to retirement where it seemed too far off, and now all of a sudden you've realized that retirement is right around the corner and you've got to get in gear, I encourage you, go to our website, Johnson, W-I-M, as in Wealth Income Management.com, and you will find a tremendous amount of resource. There's white papers, there's past radio shows that you can listen to, there's YouTube videos, podcasts, and you can even pick up a copy of my book, The Capitalized Retirement. When we think about retirement, we typically only get to do retirement one time around. And so we want to make certain that we're as prepared for that retirement as is possible. So not only can we make the transition very smoothly into retirement as we all desire, but we have a plan. We have things in place that are going to allow us to replace that paycheck with a playcheck so that we can do things that we want to do in retirement. And we want to be able to do that with as least worry and concern, and we want to be able to sleep at night. And so that's the priority and the main goal of this radio show. Now, I want to actually start this radio show with a bit of bad news. Let's just do a bit of a test here, looking at the three different indexes that most everyone hears about in the news every single day. We'll begin with the Dow Jones Industrial Average. We know it's comprised of 30 companies. And if we look at what the Dow has done year to date, it's not great. It's down 10.28%. When we look at the S&P 500, most of us are very familiar with the S&P 500. This is more large cap companies. This is the Fortune 500 index. It's the oldest and the best performing index that we have as Americans. And all of a sudden we look at it and guess what? It's kind of down in the mouth as well. It's down 12.3% year to date. And then we look at things like the NASDAQ. And the NASDAQ, more tech heavy. We know this. Got a lot of technology companies in it, and by gosh, the S&P 500 year to date is down 17.81%, nearly 18%. That's just terrible news. That is terrible news. Or is it? This is a question I really want you to be thinking about. Now, I do not diminish this idea that if you're close to retirement and you're watching all of these things happening around us, things with President Trump, things with the tariffs, things with the stock market, things with the economy, that it's not concerning. There is many things that we can be concerned about as Americans and as future retirees. But at the same time, if you're doing your due diligence, if you have a financial advisor who is privy to your retirement timeline, you're working with a fiduciary, someone who is giving you advice not based upon their business model, but based upon the you model, based upon what is best for you, what's best for your spouse, what's best for your timeline of retirement and your needs for income, I'm going to suggest to you that the opportunities abound. Now, you've heard me discuss so many times the necessity and the magic of dollar cost averaging. But for those of you that may be new to the program, I want to just briefly walk you back through it. Dollar cost averaging is one of the most magical things that can take place. Now, oftentimes it just is an automatic byproduct of us participating in a 403B. It's automatic in a 401k because we are taking little bits and pieces of our paycheck and we are deferring it into that account. And where are those dollars going? And those dollars are going and they are buying shares of various different funds that we may choose to invest in at various different price levels. And if you've never thought about it, when volatility is abounding, as it is, as it has been since really the beginning of December 2024, it is helping you because as the market goes up and down and up and down, if you're buying and you're buying at less and less of a price, what are you able to do with the dollars that you're deferring into that retirement program? And the answer is obvious. You are buying more shares and you're buying them while they are on sale. Now, typically with most financial advisors, that's about the only sales pitch that they've got. And I don't mean that in a derogatory way, but that's the way in which they're trying to speak to your logic in your brain to say, listen, this is a good thing. And it is a good thing because think about it. If you bought 10 shares of a mutual fund or an index fund or a stock at $10 a share with $100, and the next month you deposited the same $100, but this time you're buying the shares at $5 a share, you're going to buy 20 shares. You're going to buy twice the number of shares. And you spent $200. You know that you are the proud owner of 30 shares, but the real revelation is what was the average price that you paid for those 30 shares. And where most of us, our minds would say, well, $7.50. We bought some at 10, we bought some at 5. It's got to be somewhere in between. You're right. It is somewhere in between, but it's not $7.50. It's $6.66 a share. Why did the math work so well? The math worked well because when the price was low, you bought twice the number of shares. Now, I won't get into the fact that when we're in retirement, we do not want to be reverse dollar cost averaging. That's what most advisors unknowingly put their clients into. They want income and they convince you that selling the shares is the best approach. I don't believe that at all. But the reality is that if you have a participation in an employer retirement program, until the day that you retire, you want to be buying. You want to be dollar cost averaging. You're not only reporting less income and paying less tax, which is a great thing, but you're buying assets. Okay? Now, here's the thing. When we think about your IRA dollars, when we think about your Roth dollars outside of your 401k, outside of the 403b, this is where we have to be careful. Because if we want to take advantage of the volatility that's around us, and let's face it, you didn't roll that 401k into that IRA. You didn't start that 401k for your health. You probably started it as most people did, so that down the road when you're retired, you have the opportunity of using those dollars to supplement your retirement income. Here's the thing. Most people will roll money from an employer plan into an IRA, and they will employ the same exact tactic in the IRA as they did in the 401k or the 403b. Now, that may be fine if you're just focused on growth and maybe you got another 20 years before you actually get to retirement. I'm fine with that. I think that you need to be focused on the growth. But if you're within, say, even 5 years of retirement, I'm going to ask you to consider this. The one thing that seems to be prevalent amongst the IRA and Roth accounts that I'm looking at from day to day, where a person will drop off their portfolio because they want a second opinion. Guess what the number one thing that's missing is within that IRA, that Roth account? It's dividends. It's dividends and interest. And you see why this happens time and time and time again. I do not know. But why is it that we all know the dividends are great for us? We know the dividends are free money. We know the dividends help us to reinvest and buy more. Okay? They help us reduce our risk. They help us compound our return. And yet, for whatever reason, when I look at these IRAs, I look at these Roth accounts, I see nothing or next to nothing in those accounts for dividend production. Why is that? Why is it that advisors are not really paying attention to the byproduct of income? Because you see, to me, and I don't know, maybe I'm a crazy man, but anytime I'm getting paid, say, 5% in dividends on the things that I'm investing in, not only is that helping me dollar cost average, but that's like a silent partner that's paying money into my account. And of course, the account can go up, the account can retrace and go backwards. That's fine. That's the nature of the beast. But let me ask you, if the market was down and you're busily focusing on that 401k, pumping as much of your paycheck into that thing as you possibly can, why would you want the money sitting in an IRA to be idle? Why would you want it simply going backwards and retracing, now having to wait for it to recover and hoping that it's going to recover by the time you get to retirement? To me, that seems like time not well spent. So you see, the opportunities abound right now because not only can we fix this issue very easily by simply changing the strategy, changing the types of holdings that we're investing in, but we can also, by default, by taking and increasing the amount of interest and dividends that our money is producing within that IRA, that helps us to reduce our risk. Now, just consider this mathematically for a moment. Let's say that you're down 10%. Let's say that, we're looking at the Dow Jones Industrial Average. We know that that's down 10.25%. But let's say that the holdings that you have within that portfolio, they're down 10.25%, but you just got paid a 5% dividend. Now, my question to you is, are you really still down 10.28%? If the answer is no, you're absolutely correct. You see, not only is that an unrealized loss, but that dividend helped you to defray your risk and reduce it. Now, we're coming up on our first break. Sit tight. We're going to come back and talk about more of these opportunities that I think are surrounding us. Sit tight. We'll be right back. And welcome back to the second half of the Capitalized Life and Retirement Show. I'm your host, Matthew Johnson, president and owner of Johnson Wealth and Income Management, a retirement income source located in Clear Lake and Humboldt, Iowa, serving clients in northern Iowa and southern Minnesota. If you're just joining us, welcome to today's program. Today, we've started our program by just kind of addressing the elephant in the room, which is that it seems as though chaos really abounds right now. We've got bad news on every corner, it seems like, according to media, news-related outlets. And yet, is that really true? Is there just absolutely zero good news in the news? Is there zero opportunities that exist? We spent a better part of the first half of our time discussing that even though the Dow Jones is down 10%, the S&P 500 is down 12%, the NASDAQ is down almost a whopping 18%, that there is dollar cost averaging opportunities to be had. And you see, this is an opportunity for you to take better control of your money. If you're playing small within your employer retirement program, I encourage you to stop it. I know that it seems as though there could be a giant catastrophe on the horizon, but I want you to understand that we have so many more safeguards today in the marketplace. We have so many more things in place as far as diversification that helps us to avoid being completely devastated. And I'm not diminishing the risk because I know that risk abounds, but risk has always abound around us. Now I want to flip on this coin to the other side. Let's say that you disagree. Let's say that you're like, Matthew, I have so much money sitting in my 401k, you don't understand. When the market's down 1,000 points, it has a tangible impact within my account and it scares me. And you know what? I understand. I hear exactly what you're saying. So since we're in the mood of talking about opportunities, if you're not aware of this, this is something that I want you to pay careful attention to. If you're over the age of 59 and a half, you do not have to play chicken with the stock market. You're close enough to retirement that even the government knows how dangerous and risky 401ks and 403bs can be. This is the reason why at the age of 59 and a half, for most of you that are working, you have an opportunity to pursue things like a rollover to an IRA. You can do it totally tax-free. It's astounding to me when we call in with a client to do a rollover, moving money from an employer plan into an IRA, that there's absolutely no questions. It's generally done in 15 minutes over the phone or less. The custodians expect it. And here's the thing. You may have dormant employer retirement accounts. If they're not earning the kinds of interest and dividends that you deserve, if you're not making a net 5% in dividends, you owe it to yourself to get that working capital working for you. If you've got too much money in 401ks and you know that it presents a tremendous risk to you and you do not feel like taking on the kind of risk that you did 10 years ago, who could blame you? But do something about it by rolling tax-free into an IRA and making certain that that IRA money is producing that kind of interest and dividend for you. You could save expenses. You can take and increase the output of the dividends, and it allows you to continue to buy until the time in which you are truly ready to retire. But what are some other opportunities? Well, let's think about taxation for just a moment. You know, most Americans end up coming to retirement with having the vast majority of their money taxable. Now, don't get me wrong. It's nice to put money into a 401k and not have to report that as income and pay income tax on. But you know what? It's also nice to get to retirement and not have every single red cent taxable to us. Because what happens if you want to build that new home? What happens if you want to buy that new car? What happens if you have a specific project or a big vacation? I recently had clients that decided that they were going to take all of their grandchildren on a Disney cruise. They have a total of 8 grandchildren. That was not cheap by any stretch of the imagination. But the reality is that today, if we want to be looking forward and we say, okay, well, even if the next, say, 8 years are going to be fairly normal as far as tax implications, because there's going to be a renewal of the Trump tax plan. Listen, you got to be thinking beyond. You've got to be thinking beyond the next 8 years. What happens if taxes and Congress decides to change tax code down the road? We have to be thinking about this. Is it a possibility that the taxes that we pay today could go from 12% to, say, 15% or 16% or 17%? Is that possible? The answer is yes. Anything's possible. The Red Sox won the World Series not once but twice. Anything is possible. So if we want to avoid this, if we want to cut down on the pain that's realized at required minimum distribution age of 73, then we've got a perfect opportunity to do Roth conversions. Now, why would you want to do Roth conversions during this volatile time? Because the very best time to do a Roth conversion is when things are bumpy. You see, if we're doing a Roth conversion the right way, where we're not doing what most advisors and institutions will do, where they'll sell the position, they'll move the cash, and then they'll buy another position with that cash. If we're taking positions you already own that may be down, we're going to journal those positions into that Roth account. We're simply going to we're going to do a change of address. We're going to move them from the IRA account into the Roth account. That's going to stimulate to 1099, showing that you did a Roth conversion. You'll pay the taxes on that. But guess what? Because we never sold the position, we simply journaled it into the other account. As all of this that's surrounding us right now finally recovers, as things blow over, remember, this may pass like a kidney stone, but it's going to pass. Well, guess what? All of that recovery taking place within that Roth IRA account, well, that's going to be tax-free growth. And that's going to be good for you in the sense that it's going to be tax-free appreciation. It's going to be good for you in the sense that it could produce tax-free income if you are allocated toward dividends, as I suggest that you would be. So now you have taxable income, which is going to be pension income, taxable income, which is going to be Social Security, taxable income if you pull income from your IRA, but tax-free Roth income as well. And that helps you balance things out. It helps you have better control on your taxes. Now, let me give you some unequivocal proof. We started our program by discussing the markets. The Dow Jones is down 10%, the S&P is down 12%, the NASDAQ is down 17%, almost 18%. Well, let's just compare where we are today to where we were 2 years ago. 2 years ago, in 2023, the Dow Jones is up 12.9% from 2 years ago. The S&P 500 is up a staggering 24.8% from where it was 2 years ago. The NASDAQ is up 31.46% from where it was 2 years ago. You see, folks, we can't allow all of the negativity that we see in the news and the articles, even from our friends, to divert us from using what we have going on around us as an opportunity. Not only can you buy things while they're on sale today, and that's not just stocks or index funds. That's fixed income. Imagine buying an instrument that's contractually paying you income for the rest of its life, and then when it comes to the end of its life, it gives you back more money than what you paid for it. That sounds like a pretty good deal, right? Folks, that's a bond right now. Folks, that's a preferred stock right now. I teach clients how to do two things, and every single client sees the reality of these two things within their account. Number one, the reduction of risk. When we get closer and we get older, we get to that retirement stage or even pre-retirement, we want to see a reduction on the risk. We don't want to sustain 30, 40, 50% rates of loss because we've seen that before, okay? And the market recovers, but it takes some time. So we want a reduction in risk. Number two, we want a maximization of income. We want all of our working capital working for us. We want all of it working for us. We want all of it producing something always. And here's the thing, if I'm investing mostly contractually, even if I'm using things like uncontractual blue chips, but I'm holding companies that are paying me 3.5%, 4.5%, maybe even 5% in dividends, and they have a history of not cutting dividends, even though they can, it's not very likely that they will. And I want you to think about the power of that, because if we're in volatile times and you're taking advantage of Roth conversions, moving things while they're down into those Roth accounts so that as they recover, that's tax-free growth for you as they are held in that IRA, that Roth IRA account, it's producing tax-free income. But at the same time, depending upon how long this volatility lasts, you've got dividends that are dollar cost averaging within that Roth account, just like you were dollar cost averaging when that money was in the 401k. Well, folks, that's a winning combination. Do not allow the volatility of today to prevent you from doing what you need. When you think about hiring an advisor, you have expectations for that advisor. You expect that advisor to be the voice of reason, to talk you off the ledge, to talk you away from doing things that could be potentially harmful to yourself or to your family, financially speaking. You expect that advisor to help you avoid things that may come at you down the road that would be painful. You expect that advisor to find opportunities for you to take full advantage of. Well, in the reality of this world, I want you to know that as advisors, as custodians, we have expectations for you as well. We expect as a client that you're going to be open about your concerns. We're terrible mind readers. I hate to break it to you. As advisors, you have to be open with us. You have to tell us what keeps you up at night. But we also expect you to be teachable, and we expect you to take our advice. So in the grand scheme of things, I know that things can look like they're going 6 ways from Sunday. Things can look scary. They can look unpredictable. But list for me a year in which there wasn't something somewhere that created and presented a risk for all of us in the market. Anything is possible at any moment. And this is the reason why you work with an advisor, a fiduciary, someone who has your best interest in mind, not their business models. So be bold, be brave, embrace the volatility. You will never, ever be sorry. I'm Matthew Johnson. Thank you so much for watching and listening. And remember, it's up to you to make today a great day.